Good afternoon. My name is Michael Lever. I'm head of AFME's Prudential Regulation division. I would like to thank you all for joining this afternoon's call on the impact of regulation on banks' capital market activities. I'm joined here this afternoon by Rick Watson, who's Managing Director and Head of Capital Markets at AFME, by Nick Forrest, who's the Director of Financial Economics at PwC that produced the report alongside ourselves on this impact study, which we're going to talk about this afternoon, and also Pablo Portugal, who's Director of AFME's Advocacy function based in Brussels. I just want to say a word or two about what we're going to do this afternoon. Personally, I am going to set the scene by letting you know how why we wrote this report, and then Rick Watson will join the call and talk about the significant changes that the report revealed. We'll then move on to Nick Forrest, who will explain the drivers behind the changes identified in the report. And finally, we'll end with Pablo Portugal, who will describe what we intend to do with the report and what the report's recommendations are. And there'll then be an opportunity for questions and answers. And if you can submit questions, you do this by any time during the call by briefly clicking on the Q&A icon on the right-hand side of your screen, then typing in your questions. So let us begin. I think the reason we wrote the report is quite clear. The timing was right. We had seen the finalization of the Basel III proposals at the end of last year on December the 7th. And this marked the formal end of the post-crisis regulatory framework. So the aim that we set out to achieve in the report was to try and identify the role played by regulation as distinct from other factors in driving banks' balance sheet changes. Now, our study is quite different to many of the other studies you may have seen in the past. Historic studies tended to focus on a single regulation and to try and guesstimate what the impact of that regulation would be at some stage in the future. Our study differs in two respects. Firstly, we are looking at the cumulative impact of all regulations. And secondly, our study looks at what actually happened over the period between 2010 and 2016. I want to emphasize, however, that the study was not intended to be either a cost-benefit analysis or a complaint against the post-crisis regulatory regime, because we recognize that clearly re-regulation was essential after the crisis, and this has clearly stood the sector and the financial system well in terms of significant improvements in financial stability, both at the individual bank level and also at the system level as a whole. So the intention of the report was rather to make a factual contribution to the post-crisis evaluation exercise, which is already underway at the international level and obviously nationally in certain jurisdictions, to revisit the crisis regulations and to see if they are fit for purpose and are achieving the objectives they set out to do. Turning to how we did the study consists of 13 banks. That's 5 US banks, 2 banks each from the UK, Switzerland, France, 1 from Germany and 1 from Italy. And together those 13 banks represented 70% of global capital markets activities. To provide the data for the report, we went to an external supplier called Tricumen. And that was done really to ensure that we had a consistent data set with which to make our analytical exercise. And we selected the 3 years, 2005, 2010, and 2016. 2005 was sufficiently in advance of the crisis to be used, if you like, as a benchmark. 2010 was after the worst of the crisis had passed, and as the post-crisis regulation was beginning to come into force. And 2016 was the last available date that we could obtain data from Tricumen from. Accepting that 2016 is now a little way away, we also cross-checked our results against 2017 investment banking figures. And the trends that we saw coming through in 2017 were very consistent with what we learned from our analysis of the period 2010 to 2016. What we did in the exercise is we examined changes across 8 so-called level 1 products, that's things like FX rates, securitization, and so on, and 22 level 2 products, which are subsets of those level 1 products. So for example, in equities, we looked at equity derivatives. And then we looked at sort of 5 drivers of change, which Nick will come on to describe in detail in a few moments' time. But essentially, we looked at regulation, commercial performance, macroeconomic and wider financial sector trends, technological change, and individual bank performance. And each of these things we will come back to. I should stress that in the exercise, no individual bank data was disclosed, and all the figures are therefore aggregate. So that's why we did the study and how we did the study. I'm now going to pass on to my colleague, Rick Watson, to tell you a little bit about what this study revealed. Thank you.
Thanks very much, Michael. Indeed, there is a lot of interesting insights and conclusions from the report when we look at the data. And I've selected 2 or 3 slides, which I think might be of most use and interest. As Michael mentioned, the periods for which the data was looked at, we tried to get a period before the crisis, the middle of the crisis, and then the most recent data available is in 2016. And there are 6 capital markets product areas looked at, and 2 in the commercial side. Rates, credit, securitization, foreign exchange, commodities, and equities. Those product areas all include the related derivatives positions. So this report does include both cash markets and derivatives. The balance sheet impact is significant. And as you can see in a second, with most capital market product areas experiencing relatively large changes, particularly those product areas which are sensitive to leverage and capital charges and risk weights. One of the important things that I took away from the report, and I think many others will as well, is when you look at the summary numbers that Pablo will talk about in terms of conclusions at the end of the report, one of the things that, as a capital markets practitioner, I found was really insightful about this report is Prudential Regulations, at least to date, have far outweighed the impact of securities market regulations, for example, MiFID, MiFIR, and EMIR. Notably, MiFID and MiFIR were just going into effect this year, so they were outside the scope of this project. But the absolute amounts of impact of Prudential regulation is very significant. Notably, this data was also pulled together before the implementation of the NSFR, the final Basel III conclusions. If you look at the next slide, that we took 3 dates, 2005, 2010, 2016, and the dark green areas are capital markets balance sheet product areas, the 6 areas I mentioned before, and the light green areas are in corporate and commercial lending and trade finance. It's interesting to note that from 2005, 2010, before the crisis to the middle of the crisis, notably the non-capital markets balance sheets increased significantly faster than capital markets balance sheets. I think there was a perception in the regulatory and other communities that capital markets balance sheets were ballooning during these times. This chart refutes that, and actually much of the growth is actually outside of the capital markets activities. However, from 2010 to 2016, there's been a very significant drop much larger in capital markets activities, a 39% on average drop in capital markets balance sheets as compared to 12% in trade finance and commercial lending. If you go into the next slide, if you look in detail, this slide is insightful, I think, for 2 or 3 different reasons. It shows you the magnitude of balance sheet used by different businesses of our members. The dark green bars are from 2010, the light green bars are from 2016. And if you take the top 2 non-capital markets areas, you'll see trade finance is relatively small in comparison to corporate commercial lending. Both of those have dropped, but not nearly as much as the capital markets activities. If you look at the 6 product areas in the middle, from rates, credit, securitization, foreign exchange, commodities, and equities, in rates, you'll see a very significant drop-off, mainly because that product in government bonds is very sensitive to balance sheet usage and leverage. Same thing in credit, which is very sensitive to, in particular, risk weightings. Securitization actually grew slightly, but the main reason for that is because this data is global. This reflects the recovery in the US securitization market, which was significant outside of the agency security markets. There also was a slight growth in the foreign exchange balance sheets, mainly due to the growth in global trade during this period and cross-border activity. Equities also dropped. So we do think this is if you look at the final bar at the bottom of the page, you're looking at assets going from about 8 trillion down to just under 5 trillion over the space of 6 years, which is very significant. If you look at the next 2 pages, we show a bit more detail, first in rates and then on credit. These charts, and on page 46 of the report, you'll find a table which describes what the detailed product areas. But the dark green on page under 2010 is exactly the same figure that we saw before from 2010. You can see when you look at the same dark green area 2016, a very significant drop off in rate product balance sheet usage. You see a relatively lesser change, and I'll just caution that green is in repo, which has been fairly significantly impacted by leverage constraints, as would government bond trading. They're very much connected. There's still a decline in U.S. municipal bonds, which are part of the study. Not so much a change in interest rate derivatives, and a bit of a change in G10 government bonds. So you can see that it's relatively pronounced, the changes, but also, again, the key importance that leverage ratio changes have made on the rates business, including cash trading and repo. We go to the next slide in credit products, which includes investment-grade corporate bonds, high-yield and emerging market corporate bonds, credit derivatives, and loan trading. You'll see a similar type of story. In the dark and medium shade green, you'll see a relatively significant drop during that 6-year period, a lesser but still a significant drop in the other 3 product areas. Credit derivatives notably dropped as well. And then finally, on the next page, we want to show the disparity of how much balance sheets have changed there's a lot of thin lines in this chart, but it's, I think, very useful in the sense that for each of the 13 banks in the sample, this chart presents on three columns. One's total assets of the bank globally, European assets, and then rest of world assets. And on the left, you'll see banks would have growth in those product areas. And then as you move to the right, you'll see the significant variation in shrinkage. On average, you'll see 39%, but you'll see with some banks actually shrinking their businesses by 70, 80%. At the same time, you've seen some growth in some certain other product areas by similar amounts. So we think that disparity is an important thing to keep in mind in the report. I think an important thing that validates the accuracy of the numbers underlying the study. And with that, I'll turn things over to Nick.
Great, thanks, Rick. So this is Nick Forrest here from PwC. I'll take us through the next section of this presentation, which is all about the drivers of the changes. So the first section is really established that there has been shrinkage in overall terms on assets, the balance sheets in our sample, and also this big variation across the banks. The question is, so why and what's driving the changes? And often we hear these sort of challenges from regulators and stakeholders to explain, what's causing the effects that we're seeing. This next section really is teasing that out. If I just go through the approach very briefly, what we tried to do here was identify a number of drivers. It's not only just about looking at the effect of regulation, but also on picking, what about other drivers and what could their effects be, and then getting a relativity across different drivers. So a number of external sort of papers and commentaries ascribe impacts on the banking sector from things like QE, from low interest rates, from the broader macroeconomic environment, and from technology, which is changing the sector. So we looked at all those sort of things. We also looked at a few other things. We looked at fines to see if that made an impact across different banks. And then came up with these five that made it into our overall analysis. The main approach then is to get data on all of these at a product level. And then we use a multivariate regression approach, which allows us to combine them all together and help to explain the contribution of each one of those to the shrinkage that we've observed. That's all done at a product level. So going through the various drivers, the first one's regulation, and the hypothesis of this work was that regulation did have an impact on balance sheet size. And the first 3 pages take us through the regulatory driver. Now, the challenge of regulation, of course, is that it's very varied. There's not been one single silver bullet in the regulatory changes post-crisis. Rather, regulators are sort to do all sorts of things with capital, with liquidity, with funding, with transparency and markets. And they're all quite different regulations. I would be targeting slightly different remedies to the problems that were revealed in the financial crisis. So from an analytical point of view, they're all very different. They have to be combined into one overall effect that we can measure at the product level. So what we've done is we've turned all the impacts of regulations into an equivalent cost figure. So where there's a capital effect, we look at a capital cost. Where there's a funding effect, we look at a funding cost. Liquidity and the cost of short-term cash and eligible assets, we look at the cost of that. And then likewise on more operational impacts with MiFID and EMIR, we look at the operational cost. So for each of these, and this is set out on page 14, we turn them into an annual cost. We can then work those out by product and by bank to then see what is the relationship between that and the shrinkage we've observed. Importantly, we have applied this to the 2010 balance sheet. So we said statically, the business that was there in 2010, we've applied all this regulation to look at the cost. Then we compare that to how things have changed over the period 2010 to 2016. That's kind of the cause and effect that we're trying to tease out. There's a lot more analysis in the appendix to the report if you want more details on how we've gone through each of those regulations. On page 15, we look at the ROE impact, and this is not because ROE impact is a final piece that we're trying to look at in the report, but more because it explains the transmission mechanism. It explains why banks need to respond commercially to the regulatory changes. This diagram here starts with a 2010 ROE, then we apply all the various regulatory impacts that we've calculated, and this is done in aggregate. It can be done also at a product level. You can see in this diagram moving from 2010 to 2016 that the bigger impacts are on the capital side, so higher RWA intensity, more equity capital, the leverage ratio, and then some effects from the liquidity coverage ratio and the NSFR. So this demonstrates the impact of regulation on ROE, quite substantial impacts, but then doesn't really take account of the changes the banks have made. And that's what this dynamic adjustment is here at the end of the diagram. This is the 8% increase, taking us from 3 to 11. That's the combination of things that banks have done to respond to the regulations, including shrinking balance sheets, which we're interested in, but also including changing the way of delivering services to customers, cost reduction programs, which will increase ROE, and also repricing where that has taken place. And collectively, they have a big impact, restoring ROE in 2016 to 11%. Probably a bit higher in 2017 as performance has improved in the last year. So what this is not saying is that ROE is currently a huge problem for the industry. We are not too far away from a commercial or cost of equity return. Rather, it's just emphasising the transmission mechanism, how regulation impacts returns and why banks need to respond to those. The question then is, if that's the transmission mechanism, how much of a linkage are we seeing between regulation and the change in assets that we observed in the first section? This is page 16. So what this chart shows here is just focusing on regulation. On the vertical axis there we have the change in assets, so shrinking at the bottom, growing at the top. Then on the x-axis, the horizontal axis, we've got the impact of regulation, expressed here as a percentage of costs. So in the bottom right corner, what we have there is a big reduction in assets. That's consistent with and correlated to a big increase in regulatory costs. And that bottom right quadrant, there are very few dots above the zero or the positive intercept there. So all of the big regulatory impacts are consistent with shrinkage. If we then look at, if we just turn back to the 1C, if we look at the y-axis there, so if you look in the middle of the chart, what you then see is quite a good spread between the dots there. What that's showing is that when regulation isn't having much of an impact by product, there's quite a variation in results. Some banks are shrinking areas for either commercial or strategic reasons. Some are maybe growing, again, for the same reasons. And that's because they're not constrained by regulation as such. There are other drivers that are impacting things. This helps to show that regulation is clearly having an impact at the top end, but it's not the only thing that's driving balance sheet size and composition. You can also see a couple of dots on this chart that are outliers. So, particular areas where banks have made very strategic decisions, possibly linked to the rest of their business, to either shrink or grow accordingly. That's the regulatory driver. Now moving on to commercial performance on page 17. So our hypothesis here is that a product in a bank that is doing very well, and by well here I mean profitable, and by profitable I define that economically, so that's a return over and above the cost of equity, we'd expect that to grow. And likewise, if there's a low level or negative level of profitability, we'd expect that to shrink. And that's not a perfect relationship, and there are plenty of reasons why strategic products or loss-leading products or products that have good bundling aspects with other services, they may well be maintained, but it's a good guide that would expect, on average, profitable products to grow and less profitable products to shrink. So what this analysis shows here is that economic profitability by product. It does show quite a distinct variation. There are a number of products who are earning around their cost of equity in the middle of the chart there. There are also some quite profitable products, typically capital-light products. And also at the other end of the spectrum, we do have some pretty unprofitable products. So the reason for including this variable is we'd expect this to have a positive impact on explaining shrinkage. The next driver is macroeconomic and sector-wide trends. So this driver affects all banks and all products. By definition, it's wider than individual banks. It includes things like macroeconomic trends. But from an economic perspective, actually, the period 2010 to 2016 was not a particularly defining period economically. Trend growth had recovered after the immediate crisis recession. And was neither particularly strong nor particularly weak. So it was a fairly normal time for economic trends. It has, though, been a very different period due to monetary policy with quantitative easing and low interest rates over this period. The challenge there is actually there can be quite a few different effects going on. So while sort of QE supports asset prices, it can also reduce volatility and liquidity with the presence of big central banks buying up bonds in the market. So the effects on bank performance actually can be a little bit uncertain. It can be either way. Then lastly, this driver also picks up any kind of sector-wide sort of cycle post-crisis recovery. The that was going on after the crisis. That's the third driver of change. The fourth driver of change then is technology. We've clearly had a lot of technological change over the period 2010 to 2016. Now, technology, again, is one of the drivers that can have different effects. On the one hand, technology can make it cheaper and therefore more efficient and productive to provide services to customers. That can then lead to actually expanding business if you can reduce the cost of providing those services. That's one way technology could be affecting our sample banks. On the other hand, technology also is a disruptor. It can change the business models and the ways of markets working, whether that's in trading markets, whether that's in different ways of trading, which could, for this sample of banks, actually be a negative impact. So again, this drive is a little bit unclear. The way we got data on this is to look at electronification by products, and there have been studies that have looked at this. The chart on slide 19 shows the increase in electronification by product area, and it's important that product dimension is quite helpful for us. That's how we've done the study. And you can see that not only is there a big variation in electronification from the highly electronic cash equities and futures markets, right the way down to the OTC markets at the bottom, but also the rate of change has also varied over this period. That's the sort of fourth driver we've included in our analysis. Lastly, we look at bank-specific effects. So we had 13 banks in our sample, and they all emerged from the financial crisis in very different positions, and some in better shape than others. We did purposefully exclude banks that took state injections of equity. By definition, they've shrunk, been required to shrink. So we didn't include any of those banks in our study. But some were restructuring after the crisis, some were in a better position and returned to growth quicker than others. We haven't been able to really look at the phasing of those different strategies because we only have 2 data points in time, 2010 and 2016. And it's true that different banks have had different strategies and profiling for how they've emerged from the crisis. But our analysis allows us to include an individual bank-specific effect. So each individual bank is a variable in our analysis. And if one bank happens to have grown more across all its products, then we can allow for that. And then likewise, if one bank happens to have shrunk across all its products, we allow for that. Interestingly, we found the shrinkage doesn't really follow geographic headquarters. By that I mean so US headquartered banks versus EU headquarters banks. There may be a difference in performance levels that have been widely reported of late, but actually from a shrinkage point, we found not a huge amount of variation. Moving on to slide 21, we use these 5 drivers in our regression analysis. We compare it to the shrinkage that we've observed, and Michael and Rick took you through. And from that, we've created a multivariate regression that's included in the report, includes coefficients on each of the variables in there. What we can do with that is then look at how important are the different drivers we found. And this chart on page 21 does that, comparing by looking at a bridge between the 2010 asset numbers and the 2016 asset numbers. So these are the drivers that we've found that have explained shrinkage. Hopefully what comes out pretty clear here is the first driver, the regulatory impact driver, has a big and large negative effect on balance sheet assets. And that's that first large negative red block on the bridge. What we can see is that moving along, macroeconomic drivers have had an effect, but I think because of that kind of the dual nature of them, the fact they can be up and down, it's not as big an effect as I thought it might be. On the bank-specific strategies, we can see that some banks have grown even more than the regulation or other factors would expect. And likewise, some banks have just shrunk. And then the fourth block, the commercial drivers, our hypothesis about commercial performance being important comes through here. So those areas that were particularly unprofitable, even or disregarding regulatory impacts, but just in their own right, they've been unprofitable. They have shrunk, and likewise, those areas that have been particularly profitable have grown. Then lastly, the impact of electronification. As I suggested, there was a little bit double-edged, a fairly modest effect there, but if anything, an increase. in the size of balance sheets across our sample banks. So that bridge chart on Twitter hopefully kind of sort of visually sets out the differences between the 5 different drivers. Regulation, as we always thought, is not the only thing that's driving banks' balance sheets, but it is a key determinant at about 2/3 of the shrinkage we've seen in this diagram. Okay, so on slide 22, I'm just going to wrap up with a few summary points, and then Pablo's going to take us through sort of where next and what this all means. These are the numbers that we've been headlining the report with. So the first point there about the annual aggregate regulatory cost applied to the banks of $37 billion. That is a large amount of impact, 39% of expenses in 2016. That is predominantly risk-based and leverage impacts, so cost of equity. Now, there are debates around how to assess the cost of equity and how much that cost should change as you increase the amount of equity in a bank. The more equity goes into a bank, the safer it becomes, and therefore the cost of equity is arguably lower. But we have tried to take account of that by looking at a forward-looking cost of equity, but that cost is not quite the same as a pure cash cost to the P&L. So that number there, I think, from my perspective, has been helpful to illustrate the range of impacts across different regulatory, different regulations, rather than trying to suggest there's this a current cost impact on the banks. Going back to the ROE bridge, we showed that there was a big impact from regulation, 14 percentage points, from 17% to 3%. I think importantly with that, the mitigating actions and the way the banks have adapted to regulation have restored that up to a respectable 11%. So the ROE story is all about explaining the transmission mechanism, but not necessarily the endpoint. Fourth point there on shrinkage. So in aggregate terms or in overall average terms, a 39% reduction in capital markets assets. So that's a pretty substantial reduction in assets. Pablo's going to talk about some of the broader implications of that in markets. And then lastly, our regression analysis, which is to sort of combine regulation and other drivers, has accounted for around 2/3 of the decline in capital markets assets. So regulation playing a key role. And as Michael said at the beginning, this is all about regulation that has had an impact over this period to 2016. So if a bank had anticipated a future regulation, that might have crept into our analysis. But what it hasn't captured is ongoing changes the banks are making responding to current and future regulations. So if anything, these trends we would expect to carry on, we've established in this report. So that's my summary from the analytical part of the work. Pablo's now going to take us on to where next in the board implications.
Great, thank you very much, Nick. As we have explained, the purpose of this study has been to provide an empirical analysis of change in banks' balance sheets and the motivation behind these changes. And we have found that there has been a significant decline in banks' global capital markets assets, with regulation being by far the largest single driver of these changes. So following from this analysis, a key question to consider is how the reduction in banks' capital markets capacity has affected or may affect the functioning of financial markets and end users. We think that this is a key issue that policymakers need to focus on as the post-crisis reforms are reviewed or fine-tuned in the coming period. The findings of this study certainly give rise to important questions and areas for further examination. For example, will capital markets financing and risk management services by banks remain economically viable? And here we're thinking about activities such as market making in the broad spectrum of financial instruments, or the provision of hedging products to corporates, and the full suite of intermediation services that banks provide in the capital markets. Will those continue to be economically viable as businesses for banks? Will there be changes in the costs for end users as a result of increased costs and capital requirements that make it more expensive to deploy bank balance sheets in support of capital markets activities? Or will the liquidity conditions change? As we know, banks play an important role in supporting liquidity, particularly in the less liquid instruments, such as high-yield bonds or non-investment grade bonds. So these are questions that authorities have certainly begun to examine as they look at the effects of post-crisis reforms. And these are early examinations, given that not all reforms have been implemented at this point. There have been a range of studies by several national, regional, and global authorities and policymakers. And it's fair to say that kind of a key area of focus has been market liquidity, and in particular, liquidity in the corporate bond market. That's a kind of area that a number of authorities have focused on. We saw some of the early studies suggesting that liquidity conditions had not really changed or deteriorated, but more recent studies that we've seen from regulators have begun to acknowledge that there are signs of fragility in the fixed income liquidity environment, and possibly a trend towards bifurcation, with liquidity concentrating in some instruments that have become extremely liquid, but drying up in less liquid instruments that have become more expensive to trade for banks. PwC, in fact, did a study for the GFMA a couple of years ago, where they noted that various measures of liquidity and market depth have shown falls since 2010. So we can expect regulators to continue to reflect on these issues, particularly as unconventional monetary policies and such as quantitative easing are phased out, and therefore, we start to see the kind of true liquidity conditions in the market without the central bank support in the coming years. It's worth noting that in the EU context, we also have the Capital Markets Union project, and it will be important to assess how the reduction in banks' capital market activities interacts with the goal of developing the CMU, which is a key priority in Europe. So what are our key recommendations from this study? Well, first of all, we recommend that policymakers undertake more of these ex-post cumulative impact studies, and that they examine in particular how regulation impacts the economics for providers of primary and secondary market capital markets products, and their incentives and capacity to continue to offer them to corporates and investors. And here we think that one area that deserves further study is the impact from the multi-layering of regulation in a single product area. And this is important because prudential regulations and market conduct or infrastructure regulations are often developed separately by a separate set of regulators. But when it comes to their implementation, they come together and affect a single product area. So understanding those interactions between prudential and markets regulations is very important. We think that future studies should interrogate the effects of reforms on financial stability and the sustainability of banking services. And here we're not suggesting that regulations have been harmful to financial stability. Far from it. We think that the post-crisis reforms have improved bank resilience and stability. But market making and hedging and derivatives products do play an important role in the sustainability, the financial stability and the sustainability of the financial system. So it's important to look at the continuation of these products that banks provide to their users. Market making, we've highlighted, is a key area of focus, and in particular looking at the impact of the capital and the leverage regulations in affected asset classes is very important in terms of the market making function. And in relation to market conduct and infrastructure reforms, we think that policymakers need to look at how these have affected end users. And for example, the European Commission has started doing this in relation to areas such as the MiFID investment research rules and how they have affected the provision of SME equity research, for example. It's also important that regulators continue to understand the evolution of the non-regulatory impact drivers that Nick explained. Clearly, the macroeconomic environment and technology will continue to evolve and affect financial markets, so understanding those impacts is important. And finally, it's important that the key regimes in the prudential space and in the capital markets space are appropriately calibrated. And here we have in mind in particular the risk reduction measures package that is currently under negotiation in the EU, and also MiFID II, MiFIR, and other capital markets regulations that will continue to be reviewed in the coming years. So those are our main recommendations, and I now hand over to Michael Lever for the Q&A.
Thank you very much, Pablo. If you have any questions, then please let us know now. There is an icon on your screen to allow you to ask questions, and while you're all thinking about that, perhaps I can kick it off with a question to Nick Forrest here. I think one of the things that we get asked as a result of this study is, what weren't these impacts intended? Didn't regulators intend to make banks change their structures, their business models, their holding of certain categories of assets? So it's a very good question, and I'm going to look to Nick Forrest to provide a very good answer. Nick.
Thanks, Michael. So I might just go one step back and think about the regulatory response to the crisis was very much a cost-benefit equation. The benefits of a more robust, sound system that wasn't going to explode in the way they did during the financial crisis were clearly large or quantified, and there were substantial benefits. Offset against that were the costs. I think regulators accepted there would be some costs to increase regulation. But a lot of those were, I thought, to be relatively small, and often, in the way I saw the economic impact studies, a change of the price of risk would go through the system. And sometimes the shrinking of the system or smaller balance sheets was discounted. So I think in the context of that initial sort of view, this study says, well, actually, no, it's not just about repricing of risk. There's a far more bigger fundamental effects that the regulatory package has caused. So I think as things have evolved, I think what's happened with this cost-benefit equation, I think the benefits of regulation, as more and more regulation has been layered on, I think the incremental benefit starts to fall away a bit. But on the cost side, what we're seeing through this study and other studies is that increasingly there are costs that are being passed through to users, market users, and customers through having a smaller financial system that's less able to provide things like market making and liquidity. And as those costs all ramp up, I think this cost-benefit equation becomes more balanced. So it's not so clear-cut as it was right at the beginning. And I think the diminishing benefits, increasing costs means that that perspective and studies like this are really helpful in terms of working out where is the end point here, where's the careful calibration at the end.
Thank you very much, Nick. I still have no questions, so I'm going to ask Nick one more, and then if there are no further questions, I think we will close. I guess one of the charts we looked at in this session was one that showed that banks were continuing to provide a range of products, even though they were making a negative economic return from them. Sort of logic would dictate, you'd thought that banks would cease to provide products where they were earning a return less than the cost of capital allocated against those products, but they clearly continue to provide them. So, Nick, why do we think that's the case?
This is the difference between the sort of the business school theory and the kind of real world of banking here. I think in the fact that our variable was significant and actually did drive changes where we thought suggests that in principle the argument's right. Higher profitable products might grow and smaller or negative profitable products shrink. But I think the reason why we're seeing such variation, there's a couple in there. Firstly, I think the How you actually get to product profitability is not a precise science. That involves some cost allocations to different products. And so these are not ring-fenced businesses in their own right. They are integrated as part of a bank. So precisely how you do cost allocation will influence the returns for these products. Whether the capital-light products are really attracting all the true costs they bear is something that I'm sure we could look at in more detail. So I think we've got to take a little bit of a pinch of salt with the precise data. And even if the data was done exactly right and you've done the cost allocation as the best possible way you could, I think the reality is that you don't make business decisions on individual products on the basis of their standalone ROEs. You look at how they contribute to the broader bank, how they service clients, the broader strategy of the bank to deliver what it's planning. So I think all those considerations come in rather than looking at individual products on their standalone basis.
This is Rick. Just to build on that, I think from a capital market practitioner's perspective, there's some practical examples of how, for example, if you want to offer corporate bond, primary and secondary market services, or high yield in the credit side of things, or securitizations, or emerging market fixed income, primary and secondary market products, it's very difficult not to be in the government bond business because you have to be able to demonstrate to your clients that you're trading an active range of activities across the yield curve. Likewise, in corporate finance, many large corporates allocate and rotate their mergers and acquisitions business, which can be relatively, I think, decent from a return on equity perspective. But to do that, they have to maintain less profitable equity trading businesses. So I think certainly the data confirms what's actually going on in market practice.
Thanks very much, Rick. We have one question which we will being asked as sort of a detailed question just on one of the charts, which we will come back to, I think, bilaterally with the questioner. But if there are no other questions at this time, then I think it just remains for me to thank you all for joining and to thank you very much for being with us this afternoon. Thank you and goodbye.